Hey, welcome everybody to another edition of ATLalts. This is our first episode of 2025. Happy New Year, everybody. I am excited to be joined today by the team behind Quartus Capital Partners, which is a venture growth equity investment firm that I was introduced to recently. So joining us today are Tarar and Rizwan Muhammad. Welcome, gentlemen, to ATLalts.
Andres, thank you very much. We look forward to having a broad-ranging conversation about AI and other things of mutual interest.
Yeah, for sure. I mean, shout out to our mutual friend Mark Dziuba, who made our connection introduction back in the fall at the Fact Right conference in Nashville, where my partner Brian Cody and I attended. Our wealth advisory firm, Gramercy Park Wealth Advisors, is a full service financial services firm, and one of the things that we're spending time on is thinking about ways to expand our alternative investment and private markets offerings to our clients. And so the podcast is a really great way to educate, frankly, ourselves and more importantly, our clients. So while we can't, and certainly, as we've talked about, not giving investment advice on the show, and whenever people have questions about investments, they should seek professional help, whether it's a financial advisor, a lawyer, estate planner, CPA. The point of the show is really to give perspective from leaders in and across the wealth management, investment management, asset management industry. So we're excited to have you both here today. Would love to get some background. So I'd love if you could tell us a little bit about yourself and how you came to work with Rizwan to form Quartus Capital Partners, and tell us about the business.
Sounds good, Andre. So thank you again for having us on this program. My name is Afzal Tavar. I go by Al. My background is intimately involved in Quartus DNA as well. So it's think about it, our firm DNA and our personal backgrounds are intertwined in a very significant way. Um, so to give you a little bit of background, I studied AI in college in the mid 80s. So for some of your audience, they can calculate how old I might be from that. So the reason we're talking about it is we've been talking about AI and doing AI, working with AI for the last 30 plus years. And I studied some more AI in graduate school here in the US. So that has been the underlying kind of foundation on which Quartus Capital Partners exists today. So after I finished my graduate school, I spent 25, 30 years in management consulting, working for some of the biggest consulting shops in the US, including Deloitte, IBM Business Consulting, former KPMG Consulting that became Bearing Point. I actually led their Asia financial services practice out of Shanghai and Hong Kong. And then lastly, I was a partner at PricewaterhouseCoopers, PwC, in their consulting practice here in New York, as well as in China and Hong Kong. So that academic background, consulting background, gave me two ingredients to start the firm. And Rizwan added another dimension, which he will talk about in a second. So Quartus, since I have a microphone, I can tell you a little bit about Quartus as well. So Quartus is a New York City-based emerging manager. We are a new firm, and we are raising and investing in a $100 million fund to invest in mid-stage venture capital, basically Series C, Series B type. And our primary strategy is AI-based solutions to some of the most difficult problems we have in society, such as healthcare, security, and so forth. I'll stop there and pass the microphone to Rizwan so he can tell you about his background.
Thank you. Thanks, Al. Yeah, so unlike Al, I didn't study AI in college. I was a lot more focused on the hardcore, engineering, computer systems engineering. That's what my master's was from Syracuse University. And once I graduated, I came to Bay Area, and I've been here. And when you are living and working here in Bay Area, you end up with meeting all kind of technology people, get opportunity to work in great companies, definitely. So I did work for some small companies, some large companies. I was deeply focused on or interested in working for smaller companies because that's what excited me always. So I had about 4 or 5 startups. I joined initially as an employee, but towards the end, it was a 4 people effort to launch a company, which then ended up being acquired by Hitachi. So in terms of my background, it actually spans a lot. I did software development, software engineering in the beginning, went into consulting, did that for a while, and then product management. And that's where I spent about 20 years of my career. So that's my primary background. My AI encounter was at Hitachi once my company was acquired by Hitachi, and worked as a product manager there for about 15 years. The last 5 years, they were deeply interested in building solutions which were machine learning, AI, big data, analytics space. And that's how I got into AI, because the people who we were hiring, they were all data scientists, and I needed to really learn that whole space very quickly. And in 2020, when I was leaving Hitachi, I had known him, since high school. I've been always in touch with him, and he was starting a technology fund as part of his this VC venture. And that made sense to me because I was doing something similar internally at Hitachi, which was bringing solutions to the market. And in doing so, we had a kind of you could quote unquote call it corporate VC internally focused function as well, because we needed to invest in only those ventures which have potential. So we were reviewing those, we were funding them with the people as well as money. And that's how, there was an alignment with Al when he was launching this technology fund. And I joined him in 2020, and I've been here ever since.
Fascinating. Real deep backgrounds. I'm going to come back to you, Al, maybe for one more comment on just the background and the team. I know that Quartus is certainly more than just the two of you. You bring decades of experience, each in your own right. And we could spend a lot of time on today's conversation, just talking about things like setting up your first fund and being now a mid-stage emerging manager in the VC context. But there's so many other areas I want to dig into. But I'll come back to you, Alan. Maybe you can give another comment on the organization and the team before we jump into some of the themes and some of the areas of the organization strategy that I think our listeners will be really interested in learning more about today.
Thank you, Andres. So we are very serious people when it comes to investment management. So for us, this is not a hobby. This is not a gig. This is a professional fiduciary responsibility. So our current team consists of 5 people. All of them are very senior people like Rizwan and myself. We have 1 woman partner and 4 men in our core team. Each one of us have 20 plus year experience on the average, and graduate degrees. 2 of our partners have PhDs. 1 partner has 2 PhDs. One has 1 PhD and a CFA. So that's our core team. We do all things within our Quartus among the 5 of us. We don't have younger junior staff yet. It's by design. We wanted to make sure that we launched the firm with the right senior caliber knowledge and experience first. And also affordability. As we get a little bigger, we will add more people. On top of that, we have about 6 to 8 part-time partners and advisors. These are people that we reach out to for a discrete question about a particular topic. And that could be capital markets, could be particular technology, could be healthcare, you name it. So we have that ecosystem. And thirdly, we have a very large global network of contacts, former colleagues, friends, people we know personally and professionally that we reach out to for broader kind of knowledge, information, and experience sharing, so to speak.
Yeah, which is so critical in not only the Bay Area and Silicon Valley, but just overall in terms of originating deal flow, doing due diligence, sourcing
Yeah.
talent, references around the teams that are building and doing a lot of these mid-stage startups. Maybe you don't call them startups, but emerging companies that you're
Yes,
investing
yes.
in. So that human capital is in those networks, and that network effect is real. Let's talk a little bit about though the idea behind Quartus. So you have decades of experience in your own right, and you elect to express the backgrounds and experience and bring that together in the form of an investment organization, Quartus. We can't unfortunately talk too much about the fund, but I want to talk about AI and the tech focus of the business itself and where you're at. So much attention from wealth advisors, our community, right? The financial community, that's recommending strategies to clients. And what you see in the mainstream financial press and news is around what you said is generative AI. Is we're not going to pick on any one company, but it's the large language models, the things we're seeing talked about from all the big Magnificent Seven. Can you just level set where we're at today with Quartus and where your focus is? Because when people hear AI, a lot of the media goes directly to, again, a handful of really large companies, publicly traded companies, and what they're doing. But there's so much other things happening. Can you maybe break it down for us, Al?
Yes, so I think we'll talk a little bit about this. Is, by the way, multi-part question.
Yeah.
So we could spend hours talking about it, but we'll try to be more very concise. First, the types of AI. The way I see AI is embedded in my experience, how I learned AI in the 80s and early 90s. So and I'm talking about in a layman's or every person's kind of everyday language, right? I'm not trying to throw any big jargons. The AI that we have been learning and practicing for decades is pattern recognition. This is how we as human beings, as children, learn things from different colors, how to recognize colors, right? How to recognize hot from cold. That's called pattern, right? Because we touched it and our parents would say, don't touch it, it's hot. And we as children, we want to touch things. So we touch them and we learn that we should not touch hot. This is a pattern recognition. So pattern recognition is very core to animal intelligence, particularly human intelligence, right? Recognizing, experimenting, and then over time, we know day and night. We are 100% sure when it's day, when it's night, because we have seen it so many times. Second is rule-based decision making, rule or equation or formula or law-based. This is how we make a lot of decisions, like in accounting, right? Yeah, or in mathematics, A plus B is C, right? So we learned that those are formulas, right? And once the formula has been developed, has been proven, we just take it for granted. We never question it, right? Similar to laws, there could be city, state, federal laws. Once they are written, they have been written by elected officials. They become law, and police and other people and courts apply them. But that's a rule-based kind of decision making. So these two have been around for ever since humans have existed, except it became a science, 40, 50 years ago, right? People started saying, how do we as humans make decisions and how can we make it into computational kind of science? So these are the kind of AIs that I learned and I practice, since mid 80s, early 90s, right? And they've been around longer than that. Now, what we are hearing a lot about recently is artificial generative or artificial general intelligence. It's basically taking those two methods of AI and adding layers of data and complications. Now they can make very complex decisions. Complex decision could be writing an entire report, writing an entire story, creating a brand new picture, and so forth, so forth. So that's where the AGI is, right? The next one, which has not been fully developed yet, but a lot of debate is happening that it will happen sooner than later, is called artificial superintelligence. So basically, there will be systems or technologies that will be so advanced, they can actually make better decisions than human beings, right? That's scary, right? But it also has the potential of solving some of the most difficult problems. You're going to say something?
Well, I think we've heard a lot of people prognosticate or opinionate on, the impact, potentially negative impact of AI. I'm less informed around, how far the technology could go, clearly than the two of you and the AI and data science community that have been at this for decades. But when you bring it back to the wealth management and the financial context, I think a lot of investors are trying to understand, how do you think about investing around AI, right? It's clearly disruptive in many respects. I don't think you'd get a lot of debate there. I think it's clearly being applied in our economy in a variety of areas by small, medium, and large companies. Um, I think the one thing that we would love as a financial community is understand, number one, the impact on us, but more broadly for our clients, what are some of the things that we can provide to our clients around the whole overall AI debate? Less ethics, less politics, but more, what are the things we should be paying attention to? What are the things that we should be looking for? So much of the conversation has been around, the models, right? From these big, magnificent seven publicly traded companies and, the NVIDIA and the whole chip conversation. So much of the conversation has been around a handful of these companies, but clearly there's a lot more going on. And clearly there's a lot of other areas where investors should probably take note. So I think you guys would probably have a lot of thoughts around some of these other areas. So that's kind of where my comment was going to go, is what are some of the things that you guys have found interesting? And when you think about the broad industry, how can we as investors start to really unpack it?
Well, I think, Andres, in the academic um, arena, a lot of people are saying a lot of things.
Sure.
Honestly, some of them are so far-fetched even for me, and Rizwan will probably agree. Uh, so to humanize and to put it in a commercial context, right? I'll tell you how Goldman Sachs chief investment officer looks at AI. He thinks, and I think you and I spoke about this a few days ago. He looks at AI in a kind of a four layers or four levels. One is hardware. This is with NVIDIA like companies are building chips that are empowering computational technology, right? A lot of your clients will probably be investing in NVIDIA, right? People in general are investing heavily. So that's one. Second one is where a lot of chat GPT like companies are popping up. They are developing very large language models. Basically, they are studying everything that's available on the internet, right? Can you
Yep.
imagine
Yep.
any one of us reading everything that is available on internet in order for us to answer some questions? That's what the second layer is. The third one, this is where we are focused, is called AI enabled or AI based revenue generation. How to do business, how to make money. This is where we are. And this is an area where AI has been very, very powerful as a tool to help doctors make better, more accurate diagnostics,
Interesting. So
helping
maybe we,
patients get
yeah,
better outcomes,
yeah.
how to get better investment decisions made by advisor, not to replace, but adding, assisting, accelerating decision making of human being. The fourth level, then I'll stop, is AI enabled efficiency or process improvement. That's the fourth level.
I want to let you, Rizwan, jump in here because you gave the perspective of having worked at a number of startups, then you worked at Hitachi, were involved in their corporate venture capital activities. Um, I think it's fair to say that those are two sort of opposite ends of the spectrum. A small, nimble startup environment, right, to a large global organization. When you compare and contrast those two environments, it might offer you, the ability to provide some unique insight to our listeners around when you hear Al break that down in terms of the four areas that the Goldman Sachs CIO outlined, where investors can look at AI. The third and fourth areas, the revenue generating or revenue enabling AI areas, and the process improvement. When you hear that, can you give some more concrete examples from your background, whether it's early stage, mid stage companies that you are seeing from earlier in your career or can think back to, or just bigger corporations where they can bring this technology to play?
Right. So that's very interesting, because so far, before this whole chat GPT kind of came into the picture, and the work on natural language processing kind of started, if you look at the technology, mostly it came from small companies, startups, and that's how you suddenly change the world.
Yeah,
But this time it's slightly different. It was the Googles of the world who are investing heavily into AI way earlier than any small startup actually came into the picture, right?
sure. Yeah.
So
And as part of that, the cost, was that the cost, or they
it
had the
was
academic research,
yeah,
they had the
there is
scientists?
absolutely. I think there is a cost aspects to it. So let me actually take us back a little bit. So Al talked about 1970s, 80s, when he was kind of learning AI. Even neural networks concept was there, but why nobody was using them? There were really two reasons. One was, in order to train any kind of neural network, you need huge compute power. It didn't exist,
Mm-hmm.
right? And second thing was data and tagging of the data. That wasn't available. So if you wanted to build a LLM back in 80s and 90s, you didn't have these two things. You couldn't really do it. It became possible after the internet came, and the World Wide Web actually became enabled, and all the data basically started getting accumulated. And then the companies like NVIDIA came because of a very different reason. They were kind of working on the graphics chip. I mean, this is how they started, but they were able to provide the compute power which was needed for the training purposes. And where were all those things available? In big companies,
Sure.
Google and Amazon and all those places. So it was very natural for AI to begin over there, which is slightly different than any other technology. You can look at IoT or any of other technologies we have seen, even internet. I mean, they were all started by small companies, right? So that's a fundamental difference this time. That's the big guys who are coming in, they had the infrastructure, they had the data, and they were able to spend huge amount of money which was needed for it to kickstart. And that's how it had happened this time. So that's a fundamental difference in this technology. Now, hype. We have seen, no matter which technology you talk about, there is always a hype cycle which you go through, right? And in the beginning, it's not kind of working, and then at some point, people become overly excited about it. So there is I would say more than a technology hype, there is a business hype always, right? People think they can make millions, and so people start investing in those technologies. And at some point, you realize that, wait a minute, there is limitation to everything. It's not exactly what we imagined it to be. And then, you come down, and, the whole hype cycle actually goes on and on. So I think we are kind of there. The reason why so much money is suddenly getting invested in this space is because of what OpenAI did, right? They took the research work which was being done at Google. Attention is all you need. The transformer concept, which was basically presented, and they pumped in a lot of money and they used it for natural language processing. And they were themselves surprised. If you really listen to the CTO of, the earlier CTO, Eliar, he himself, when you listen to him, he says he was surprised the kind of results they were getting after the training. So that's why the hype got built up, right? And it is amazing. I mean, if you really look at, if you talk to ChatGPT, it gives you answers now which are quite exciting and interesting. But at the same time, when you look at these LLMs which are being built for the healthcare purposes or for some specific purposes, people say for healthcare, for example, LLMs are not there yet. There's a lot of progress which has been made, but they are not there yet, right? So slowly people are kind of realizing where the technology is, how much of it is hype, how much of it is true. At the end of the day, building up an infrastructure, of course, some of the companies are going to benefit from that, which is NVIDIA's of the world right now. But at some point, that cost has to be recovered. And that's where my worry is that, if you really look at the amount of money being spent on the infrastructure, and if the top vertical solutions, which Al talked about earlier, they don't come in and they don't start, generating revenue, who is going to pay for it? I mean, right now, Google is paying for it. Meta is paying for it. But at some point, it has to make a unit economic sense. So
I think this is where the,
Yep.
if I may, closing the loop on a remark Rizwan made earlier, that pretty much all major innovations in the US have been created by smaller companies. So these two first layers, we talk about NVIDIA, which is hardware, and then large LLM models. That's where Microsoft, Oracle, and the likes are putting billions of dollars, right? But the vertical solutions that we talked about, AI-based revenue generation and AI-based efficiency, those will be done, and they're being done by smaller companies. And those are the companies that we invest in.
Yeah. Yeah. So let's dig into that.
So they are not trying to change the world in a comprehensive way. They're saying, I want to change a particular part of healthcare. I want to transform chronic disease management. I want to transform how people learn in schools and colleges, how to make it better, things like that. So they're fixing a narrow but very specialized problem. All those are small companies.
Yeah, I think the areas where you're focused at Quartus are areas that a lot of our listeners can relate to, right? Education, healthcare. We've talked about
Security,
security, right? Cybersecurity
logistics.
is a big area, and then I know that fintech is another big area
Yeah.
that is going to be included. So across those four, that covers a very large segment of our GDP of the country. A lot of companies. There's certainly a lot of innovation within these trillion-dollar categories, call it. And what you're saying is that there is going to be vertical category winners, if you will. These companies are going to provide solutions to improve the healthcare outcomes is the goal, right?
Correct.
So can you talk about why those companies need funding from a company like yours, right? So these are early stage businesses. You're not investing in the seed and Series A or maybe Series B. You're looking at them at a little later stage. Talk a little bit about why they continue to need capital and where your stage of capital, more importantly, comes into play, and why it's so important.
So I think maybe the last question first. So we tend to invest in companies that have been around for on the average 5+ years. They have developed product, service. They have been able to sell successfully to commercially paying clients, and they have meaningful revenue. And that revenue could be $1 million plus, could be $5+ million. On the average, $3 to $5 million annualized revenue. And that's what we call early growth. So they have been around, now they are about to grow. So they need money to grow their business. So that's why we call venture growth investment. In this investment cycle, the risks are much less, but upside potential is still quite significant. Actually, Cambridge Associate, which is a $300 billion investment firm, you know them, they call this strategy as the best risk-adjusted return strategy. So this has the upside of a traditional early-stage venture capital, but it has downside risk protection of a more mature, businesses like buyout, right? So that's where we invest. Now, what some of these companies are doing now would be unimaginable a few years ago, thanks to the innovation in AI. So one particular company that we talked about is AI-based chronic disease management. So chronic disease, by definition, is a disease that cannot be cured. And hence, this needs to be managed, chronically over the life of a patient. And examples are diabetes, dementia, Alzheimer's, et cetera, et cetera. So for patients who are going through these chronic diseases, let's use dementia, early dementia as an example. These are Medicare patients, mostly 65+ year old. They take on the average 10+ prescription medicines. And they have been on prescription medicine for decades, years to decades. So the data that has been accumulated for that single patient is millions and millions of lines or records or data points. So an AI-enabled software can go through that in the matter of minutes versus a doctor going through this. Can you imagine a neurologist reviewing 30-year or 20-year or even 10-year worth of data of a patient and trying to understand what this patient might be going through in terms of dementia? AI can help the doctor do that. So this company that we are investing in is using DNA, blood work results, prescription medicine history, and personalized kind of lifestyle questionnaire. They take all that, and the AI model generates a report for the doctor. But this report is different than what a large learning models will generate. It's not generated by model. It's generated by a more complex AI system. Everything in that report is footnoted with a fact and science. So everything in that report is defensible or defendable by the doctor. That's the difference. That report is being generated in 3 minutes. If a doctor had to do the same work, it would take him or her weeks.
Sure. Yeah.
To go through the data. So that's where the significant value is created by this kind of technology company. This is just one example.
Sure. Yeah. And you can see, I mean, just in that example, the cost savings and the efficiency and productivity gains. And therefore, you can imagine a health system would say, that's software or that's a technology that we need, and we need to license it or purchase it, what have you, and that creates a revenue, right? A recurring revenue for a software company, right? I think we can all sort of relate to and identify with that type of an example. Rizwan, I want to ask you, when you hear that example from Al, which is one from the portfolio, or you look at a prospective investment opportunity, as Al said, these are businesses that they've got recurring revenue, 1 to 5 million. They've got product market fit to some extent. I think we all use in the startup landscape. They've got they're now looking to grow, right?
Right.
When you look at these businesses across the verticals that you're focused in, how do you go about filtering? And you said the word earlier in the conversation, hype. I don't know if it's hype when they're that far along, but there certainly seems to be a lot of companies that if you peeled back and saw what were they doing 4 or 5 years ago, what are they
Yeah.
doing today, is, the skeptic might say, well, they're just saying they're doing AI now and they're doing all the same things they were doing before. That's probably oversimplifying it. And that's probably not the case. But how do you really understand the science is real, the technology is real, the solutions are real beyond just looking at the revenue numbers, and that this is not a company that's going to get replaced, quickly, and that is in fact durable and has something that is repeatable and is going to be a category winner? How do you identify that?
Right. Yeah. So it's our investment framework is such the way we analyze these companies that foremost we look at if there is a real business problem they're trying to solve. I mean that still stays, right?
Yeah.
And after that we start looking at the technology, the deep tech, what they are using, how they are using it. So we know there are 4 or 5 areas where AI right now is actually hot or is much more applicable, and everybody knows about them. There is the fintech space you talked about, there is healthcare, there's education, right? So at least those three are on the top, and then there's industrial. So we kind of analyze our companies, which we are looking at from that lens. And so you talked about, I mean, Al was giving an example of a healthcare company. So this company essentially still uses in its core the rule-based engine. It's a decision support system at the end of the day. So in each and every area and field, AI's application is going to be slightly different. What problem you can solve in each area is different. So in healthcare, we know that, yeah, at some point, decision support systems could be leveraging LLM, but LLMs are not ready yet, right? So we are very careful from that perspective because we don't want to be investing too early in a company which is actually using that as a technology. But as long as they're using AI, which is rule-based engine, decision support system, we are good. Now there are spaces, there are areas where they can leverage the modern generative AI as well. For example, as a part of analyzing the research papers and extracting information from there, building rules out of it, which is a natural language processing problem. So are they leveraging that? So that's what we look at, right?
Yeah.
So similarly, classification part, when you look at, identifying or diagnosing cancer, the binary classification, whether you have a cancer, not have a cancer, those neural networks are available. They are pretty good, right? They are better than humans, right? So this is how we basically, on case-by-case basis, we analyze that where this technology is being leveraged, where it is being used, whether it can actually be used over there or not. Are we too early or too late from that perspective? So it's a art plus science. I mean, there is some methodology which we use to filter out things, but at the end of the day, it's really our background. 25, 30 years in the industry, you have seen things, and
Sure.
you've seen hype I mentioned earlier. And
Yeah.
so if you understand the technology, you can sit down and see that whatever problem, quote unquote, business problem, is that valid? If they are trying to solve that, how they are solving it? Is it a solid technology underneath, or is it?
And we can see hype.
Right.
So we don't touch blingy things, we call it,
Yeah.
shiny things. Everybody's saying this is going to be the hardest thing to, like if somebody comes to you as an investment advisor saying, using an example, saying, Andres, I have the best security that you and your client should invest in. Would you invest in it? Probably not, right?
Yeah.
It's like, if this is too hard, it is too hard. So we don't invest in too hard an area, too hard a company, because of obvious reasons. We want to see this is mature enough. This has been established enough. There's enough data to substantiate that this is a good place, good area, good sector for us to be in.
Yeah. I mean, as we were talking in recent days, and I was preparing for our conversation, the things that, again, contrast what you hear in the financial press. What we as advisors are getting all the time bombarded is, again, to your point out, a lot of investment ideas, everything, traditional, alternative, so much as AI now. Like you see AI mentioned, and I'm sort of skeptical because how much of it was AI before and how much of it is now AI because of marketing, and that's what the marketing team suggests should be in there, because it's a buzzword, right? And it's going to catch people's eye and attention, right?
I absolutely. So I think one thing for your audience, another piece that I recently read in Financial Times, one of their reporters, she came up with the idea to humanize this artificial intelligence. So she said, why do we call it artificial intelligence? Why not call it, you know, uh, uh, augmented intelligence or accelerated intelligence or assistive intelligence, basically assisting human being to make better decisions, you know. And so it's just a word, but there are serious concerns around the safety and ethical aspects of AI, which is being looked at by many people around the globe, including us, right?
Yeah. Well, and there's no
So
doubt.
how
Yeah.
to avoid
Yeah.
bad situations. So I want to make sure we convey to your audience that there are a lot of safety measures built into all practical application that we are investing in.
Yeah.
We do not invest in any area that has not been well established or proven beyond reasonable doubt, you know. And we have convinced ourselves that this is a commercial idea. This is not a academic or scientific idea.
Well, and and I don't see a lot of consumer app focused, retail focused, investment, um, themes in your material and when I hear you talk, right? It seems that it's more focused at that commercial level, right? Healthcare, education. Now, again, an education company, an ed tech company may be trying to provide and utilize AI in their ed tech software that's ultimately going to go in front of a classroom of kindergarten through 12th graders in the public schools across the country, or maybe in Europe or Asia. But there's consumer apps that are focused on, going after the app store with the AI, and then there's stuff that's built for industry, built for enterprise, and that sounds like where, Quartus is really
Right.
focused.
Yeah,
Right.
we are absolutely not a B2C.
Right.
So
Yeah.
by design,
Yeah.
there's nothing wrong with B2C, but we
Sure.
don't do B2C. So we are B2B,
Right.
because we believe that is a more mature, established, safer, and we understand that area better.
Yeah,
Rizwan.
for sure. Well, I think one thing that came through in really trying to dig in and research Quartus, because with our podcast, one thing that I'm always trying to do is make sure that I have a reasonable understanding of what the team's doing and the space they're investing in, not only because we're trying to get educated around this space, and this is a great way to do that, as we talked about, but also because ultimately anybody that we're going to put in front of a client, and we're not currently working with you, full disclosure, we're educating ourselves and ultimately want to be informed so we can educate our clients. And the big theme around AI is not going away, number one, but number two, it's much bigger than just uh, LLMs. It's much bigger than just
Yes.
NVIDIA and AMD. And, what are these public Magnificent Seven companies going to do? And I saw a chart this morning, here we are recording January 6, 2025, from Goldman Sachs. We bring them up again, and it was a chart showing, the Magnificent Seven. If you looked back 2 years ago, start of January 23, through basically the last 2 years, the Magnificent Seven are up, 240% as a group. The smaller cap publicly traded AI enabled companies, up, but just not as much. And the question they were, I guess, offering in this article was, is that going to change? Are we going to start to see some of those smaller companies? Because when the Fed dropped rates, a lot of the, I'm going to say the bottom fell out, but when the Fed began that cut, and who knows what's going to happen? Everybody's talking about the Fed
Yeah.
and what they're going to do in 25, but the growth has been in those 7 companies, right? And particularly Nvidia has been largely carrying the market from the public standpoint. We
But
as a
that has
firm,
slowed down. But that has
it
slowed
is
down
slowed down,
already.
right?
And in the same column that I read in Financial Times, where Goldman Sachs was quoted on a different point, there is a feeling, a sense that a peak has been reached for
Yeah. I mean,
NVIDIA
and the
and also
question
for
is,
LLMs
where
as well.
else do we look, right? Where else? And
That's
that's
where
the
the small
point.
companies come in.
Yeah.
So
And that's
small
where small
companies
companies.
have been the frontier of innovation, right?
Yeah.
This is
Right.
where, and that, no, they are going to lever all the billions of dollars that NVIDIA, Microsoft, and Oracle have put into these clouds and LLMs. These small companies are going to benefit from them.
Right.
Yeah.
So that
I mean,
brings me
look
to
at
yeah, that brings me to a point I would love to ask both of you, and I'll let you guys decide who answers that. In venture, whether it's early stage, and maybe for you, when you think about venture growth equity or mid stage venture, it still is about the idea of a funnel, right? And the idea of you want to have a lot of really quality, not just general companies, but quality, using the baseball terminology, quality at bats, top of funnel, so that you have a lot to look at. And as someone once said, it's all the only way you can draw comparison is when you have multiple things to compare, right?
yeah.
So when you think about the Quartus fit, right, the terminology that you use, you all look at a lot of companies and you have a team, right? As you described, you have, 5 of you. How do you begin that qualitative, quantitative march to get down to ideas, to the things that you want to spend more time on?
I will let Rizwan answer second part, but I will add a front part first. So think about this, Andres. We are actually benefiting from many other funnels first. So before the companies comes to our funnel, that company has gone through 2, 3, 4, 5 funnels already. Do you follow me?
Yeah, in
So
terms of the
they
rounds
have,
of capital they've already
yes.
raised.
So
Yeah,
they have
sure.
it.
Right.
So, it's just like we are benefiting from the company's difficult, you know, life or the time horizon they have gone through. By the
Sure.
time they come to us, they have meaningful commercial revenue. Technology has been established, solution has been established. Yet we go through a very deep due diligence, which Rizwan will comment on.
Right. So Al is right. I mean, still, although, there's that filtering going on that we are, investing mostly in the Series C, Series B. But there is other filtering going on. The people who are sending us the deals, they are very careful in terms of what they send us, right? But then still, we get so many deals. It's maybe 10 a day or more than that. I mean, that too, after filtering. I mean, there is an email filtering going on between Al and me if we are getting it directly or if people are submitting. But beyond that, the mechanism which we have established actually is a multi-stage process. So we do initial filtering, which is based on that criteria which we have set up for our fund, essentially that we are going to be investing only mid-stage companies which have certain amount of revenue, and they are in these 3 or 4 spaces. So that filters out a lot of stuff. Right?
Sure.
Then we also are aware that we are a small fund, right? And so we cannot invest in those areas where huge amount of capital is needed. I mean, robotics, for example. We love that space. We know artificial intelligence is going to have a huge impact on robotics, but we are a small fund. This fund, first fund is small. Eventually, at some stage, we'll open it up because we love
Yeah.
that area as well. So it filters out some of stuff like that. And then based on my experience at Hitachi, because we were building some sort of a very easy to use process and mechanism, we have actually leveraged some of those concepts and built our own scorecarding mechanism, which is based on 9 or 10 metrics, which
Yeah.
are, the financial metrics as well as other metrics. And that's what we use. That you were talking about the comparison, right? So
Sure.
we generate charts out of that, which actually help us compare companies against those which we already invested in, where they fall in the category. And that actually provides a great discussion point internally. It's just a tool. It's not the final decision maker. It's a decision support system, if you want to think from that point of view. So that actually helps us do the comparison. And this is only those companies which have come through the filter, right? Then after that, once we identify a couple of those which are actually really at the right spot in terms of the charting which we do, then our due diligence actually starts, the deep due diligence, right? Which is a long process, looking at their data rooms and so on. This is where the earlier conversation which we had, that depending upon which area that company is, we deeply look into the technology, where they are using or leveraging AI, how they are leveraging it, whether it makes
I
sense,
mean, we look at patents, we look at
patterns and all those.
how they
Yeah.
use AI, what kind of AI they're using, how sustainable that is. So think about it, capital efficient companies. So
Yeah.
capital efficiency is very important. And we are trying to create a concentrated portfolio of 10 to 12 companies, not 100 companies. And out of these 10, 12 companies, we are actively engaged in helping these companies improve their speed of growth, their strategy, their market access,
Yeah, because you probably want to land them, as you say, and then expand, right?
Yes,
You want to get going with these companies, but then as they grow, you want to participate
yeah.
and be a part of that growth. That's going to
And
benefit
that's why the
your LPs.
management team is part of that 9 metrics which we look at, right?
Yeah. Yeah.
Because we are going to be working very closely with the management team. We want to see if they are mature enough to be able to go through difficult periods. Every company is going to see those difficult periods. Can they pivot if there is a need to pivot based on how the market is changing? So all those things actually are a bit of an art as well
Yeah.
when you talk to people.
One of the areas, as a firm at Gramercy Park, and I like to interview portfolios and ask them about the notion of risk management and margin of safety and some of the things that when you talk to a venture manager, whether they're early stage or they're mid stage, risk management and margin of safety don't often come up.
Yeah.
They sort of, I think, believe they're paid to take risk, and 1 in a 20 hit rate is okay. For us, as a wealth advisor and a fiduciary, that is maybe how some advisors may look at it, but we don't. We're looking for diamond in the rough portfolio managers and emerging managers for sure we love because we want to find those teams that are highly incentivized and motivated early in their life cycle. Nothing against fund fives and sevens, but we like to find the teams when they're early, fund one, fund two, as the emerging manager because there's a lot of skin in the game and they're generally very, very focused on getting to the next fund and very focused on returning capital. So maybe leave you a chance to comment on margin of safety, risk management in the context of early stage technology investing.
So Andres, I think for early stage venture capital, your statement is absolutely correct. So a lot of early stage venture capital firms would say, we are being hired to take risk. We're
Sure.
taking risk. We are investing in 100 companies or 20 companies, and 1 or 2 of them would be successful, and they will make it worthwhile. Our strategy is the opposite of that. So our entire thesis and strategy is that pretty much all of our companies should be successful. Not 1, not 2, not majority, all of them. Now, the difference will be some will be more successful than we expected, some will be less successful. Some will be successful sooner, some will be successful later. But the idea of completely wiping out the capital that we invested in a company, that is not part of our what you call a calculation. So we don't say we are putting in 10 companies, we expect 1 company to blank out. Now, statistically speaking, for this strategy, according to Cambridge Associate paper, the capital loss ratio is 13.5%.
Yep.
What that means is it's not the idea of 13.5% companies will fail. That's not the idea. The idea is after you complete all the portfolio investments, you might lose up to 13.5% of the invested capital. But your remaining 80+% could generate 400% return, right? So that's why Cambridge Associate concluded in their study that this is the best risk-adjusted return strategy. And that's why we like it, right?
Yeah.
So very risk management focused strategy in everything that we do. We try to avoid the downside risk. So we have very severe protections in liquidation preference, priority or seniority. Then we have the participating preferred shares. We never ever invest in common shares. So we are typically the first to receive the capital before anybody else receives. If we are Series C, Series D, right? Sure. So there are many different steps that we take to what we call managing the downside risk.
Yeah, I mean, structure matters. I mean, so much of investing at the diligence that we've conducted, you often can find a portfolio management team that are great at sourcing, but they might not have been cycle tested, or they might not have been through, setting up a fund before, or they may not have the breadth and depth of team, right, to really back up the claim that they have the network. And so all these variables come into play when you're doing the diligence on the manager and the management team. But yeah, risk management and the impairment of capital, particularly permanently, I'm particularly focused on that when it comes to the private markets, because of all the other challenges that you are presented with: liquidity, the level of requirements from a compliance, sophistication, accreditation. The capital commitment is bigger, and there's just so much that we as an advisor have to be able to do to demonstrate we've done our fiduciary duty. Unfortunately, we don't have a lot of time, but I want to give each of you gentlemen a chance to make a final comment. Maybe I'll start with you, Rizwan. And it's been really fascinating to talk about not only the moves in AI, but also just your experience and Al's experience in terms of setting up the business and how you're really formulating your approach. When you think about the background you have, where you're at today at Quartus, and what all this inbound activity must be, it sounds like it's a challenge in and of itself just to process it all. What gets you most excited, though? We're early in the new year for 25. A lot of people are sitting around, probably reached out to their advisor or going to reach out to their advisor and ask them, what are we thinking about for 25? We're coming off really good returns in the S&P over the last couple of years. But what gets you excited in particular with your background and your stage in your career and this new platform that you and Al are building? What's cause for optimism? Curious.
We have come through a very difficult period in terms of the fundraising
Sure.
For the past, and then COVID was there in 2019-20. So very difficult, challenging time. For the past 6 months, what we have seen is, for us at least, I mean, I'm sure the market is still going through that difficult period in terms of fundraising, but we have seen tremendous progress in the past 6 months. And that's what actually makes me very excited, because, want to get over this hump of raising the fund and focusing on the companies. We have great 9 companies right now, right, in our portfolio.
Yeah.
And we want to focus on them. We want to go and help them and bring them out, right? So that's what, I'm very excited that 2025 is going to be one of those years where that pivot will happen, that we will, have we are done with the capital raising, and we are actually focusing on companies and helping them out. So that would be very exciting stuff. And from the technology point of view, we know, AI is becoming more and more prevalent everywhere in each and every field. How the market actually changes from that point of view. You talked about big caps versus mid caps. Mid caps definitely are making progress, which is a very, very positive, healthy sign. I mean, I'm looking at my portfolio in Fidelity, and if I look at some of those mutual funds, last year the largest gain was in the mid cap mutual fund, which I have 60%.
Yep.
So that actually tells you, right, that the tide has already shifted in favor of, which is actually very positive from our perspective, because these companies are going to be the mid cap first before they become big caps.
Sure.
So opportunity is definitely there. It's just matter of executing now.
Fantastic. All right, Al, you get to bring us home here with the final comment.
So final comment is for your audience. AI is here to stay. There are some scary potential prospects that many of us sometimes think about. I would advise your audience to not worry too much about them now, because a lot of people are looking at those negative or severe possible impact. They are possible. They are not necessarily, probable, in the near future. Governments, agencies, people, professionals like us, focus more on the positive, constructive benefits of AI to many human endeavors at work, in business, in law, in security, in healthcare, education. That's what keeps us optimistic. That keeps us excited, motivated to push forward.
Oh, that's terrific. Well, look, I really appreciate the chance to talk to you, Al Tarar and Rizwan Muhammad, founders of Quartus Capital Partners. They're focused on the growth stage of venture capital with a technology and really an AI focus. Al, what's the way that folks can learn more about you guys? How can they get in touch with you? Because I always love for people that listen to the podcast for be able to get in touch with our guests.
Our website has the way to reach out to us. Our website is quartuscap.com, QUARTUSCAP, one word.com. So if you go to quartuscap.com, you go to our contact page, you can send us email, you can subscribe to our materials. So we welcome any and all people to reach out to us.
Awesome. Well, we'll leave it there for today, gentlemen. Thank you for joining me today on the podcast. It was a fascinating conversation on AI and what you're building. I wish you guys good luck in finishing up the fundraise for your first fund, and I look forward to having you back on the show perhaps later in the year to get an update and hear all the developments in the portfolio. But we'll leave it there for now. Happy New Year.
Happy New Year, Andres. Thank you very much.
Thanks, Andres.
All the best.
Bye-bye.